Hello everyone, my name is Clément Gignac. I'm Chief Economist and Senior VP here at the High Financial Group. Over the next 5-6 minutes, I will try to summarize, in fact, the webinar that we had just recorded a few minutes ago about the big picture investment strategy. So as far as the big picture is concerned, the worldwide synchronization continue. So we have a pretty strong worldwide economic activity and economic growth as we speak this year. In fact, as a matter of fact, the IMF has revised upward their forecast, and now they talk with the GDP close to 4%, which is the best since the financial crisis experiment 10 years ago. So keep in mind that even if U.S. economy is probably in the 8th inning of this baseball game, it's not the case in Japan, it's not the case in Europe, and we have still a lot of fuel left into the tank. Talking about Europe, unemployment rate continue to decline. The ECB has mentioned they will start to normalize interest rate next year. Of course, you have recently this little turbulence related to the Italy country with the new government coalition. But make no mistake, Italians trust more the European institution than even Italian institution. And if you make a survey, people in Italy prefer to remain in the Eurozone. So for me, it was just a buying opportunity, this turbulence that we have seen recently. Shifting to the other side of the sea, talking about Japan, for example, we have now the best business confidence reading ever seen in 20 years. Keep in mind that we have gone with fiscal reform. We have seen labor reform as well, because even if the demographic growth is pretty flat in Japan, we have job creation accelerate thanks to this labor reform, with the female participation start to skyrocket out there, so which is good news, and earnings grow at very decent pace as well. China, the business transition continue. They shift from capex-driven, export-driven, more to the consumer-driven, with this middle class continue to grow. Take, for example, we have now more iPhone sold in China over the last 3 years than iPhone sold in U.S. market. So that tells you something, that the middle class continue out there. In U.S., the business cycle continue. We heading now to the longest business cycle in the U.S. modern history. So by year end, it will be the longest business cycle in the U.S. modern history. Keep in mind that contrary to the food you purchase at the grocery store, you have no expiration date for a business cycle. It's just like the bull market. In fact, the condition for a prolonged economic cycle is when inflation and wages is under control and you have no significant financial bubble. And we have a risk factor growing out there. Reason is the protectionism that we have between our rising protectionism that we have from White House. So this is something we watch very closely, because they have the potential not necessarily to create a recession anytime soon, since external sector in U.S. is only 15% of GDP, but they can create a slowdown. In addition, keep in mind that the current fiscal reform in U.S. has stimulated the economy a lot this year and next year, and they could create some slowdown in 2020. So this is something we watch very closely, the impact of fiscal reform, to be sure they not create a boom-bust scenario, and this protectionism rise between U.S. and China, something that we have never seen in the past. Keep in mind that, in fact, for Wall Street, globalization has been a very good thing, because more than 40% of the big S&P 500 multinational firms have revenue outside U.S. So if you go to protectionism with tariff and retaliation, it's not really good news for Wall Street. So this is something we watch. Make no mistake, no complacency. So we watch and explain probably why in our portfolio we have some put option to protect the downside risk. This protectionism may have an impact on Canada as well, because Canada, make no mistake, the economy running very well as we speak. Unemployment rate is low. We have a very high employment participation. Housing market is okay. But since export to U.S. represent 25% of the Canadian economy, if we go with additional tariff and now shifting to automobile, it's not confirmed yet, yet, but this is a threat that we have. This is a risk factor we will monitor very closely. So as far as interest rate is concerned, we see the Federal Reserve continue to pull the trigger, so you will see a gradual normalization of interest rate in US, probably 2 additional hikes by year-end and 2 or 3 next year. But in Canada, this NAFTA uncertainty creates a dilemma for Governor Palas, and we think that maybe one move additional this summer, and after that they will go on the sideline due to this uncertainty. Talking about the capital market, the good news is this bull market so far has continued. We have a positive return year to date. Keep in mind that we have already experienced 9 years of bull market in US with 30%, 300% vintage. So as mentioned on the business cycle, you have no expiration date, but the risk increase thanks to strong earnings that we have right now. But using the past as a guide, when you have 20% earnings growth plus, very often it's pretty modest, the upcoming return. So that's the reason we think that we have more fuel left in the tank if you check on Japanese case, European case, than US case. So our investment strategy, we take profit and scale down US exposure and increase exposure to overseas. So if you want more detail about our strategy, we invite you to watch very closely the webinar that we have just recorded, and it's available on our IA website. We invite you to consult our financial advisor who will help you to propose a good strategy given your risk profile and your age and your investment objective. So in the meantime, I wish you a very nice summer.